In 2.5 months, I'm becoming a first-time dad. I'm really excited. And being a good German and being passionate about personal finance and investing, of course, I already started thinking of how I'm investing for my little son. And unfortunately, I see a lot of parents leaving this decision for way too late. And this time can really work against you or against your child. So that's why I think this video is well needed. And I'm going to share with you what I'm going to be doing and exactly how. And the cool thing is, it doesn't matter your income level. Even if you earn very little, you can still start, and you should be starting as soon as possible. And it's not about making them a millionaire, but you want to give them a head start, right? Ultimately, it's their choice what they want to do with the money, but you want to have the money available for them. And then obviously you can decide later on whether you're going to use it for the university or whatever, but you want to have a cushion of money sitting there ready for them, not when you reach the age when they need the money and you don't know where to pull it from because you're already committed, you have no money set to the side. So I think it's super important. You see that over here, just with 50 euros a month, over 18 years, it can turn into 23,000 euros. So it's just a small example, but in a second, we'll come to more examples to see how much your money could work in their favor over time. If you started later, that will be significantly less. So the earlier you start, the better it is. And I'm definitely going to do that from day one, literally. And the point of this is not that on the 18th birthday, you're going to give them a big fat check with a big number on it. The whole point is to give yourself, but more importantly, your child options, right? Again, those options can be in the form of, giving them some of the money, or eventually, if they're really good with money over time, transfer the entire portfolio under their name, or cash out the money and then use it towards their college fund if they decide to go to a fancy university, for example. But if you leave this for too long, you may not have these options, and then you're kind of forced to either maybe sell some of your own holdings, or I've even seen parents who downsize their house because they had to sell to have some money to use for their kids' college funds. So you don't want to be in that situation and rather be proactive to invest for them to once again have that optionality. And how you want to structure it is up to you, but I would personally structure it in a way that I have a separate dedicated account for my kids, right? So it doesn't mix with my own investments, because then it gets a bit murky, right? You don't know what part of that is yours, what's for them. And also psychologically, let's be honest, once you see your portfolio grow to a certain number and then to sell some shares later on and give it to them, I don't know, it's just a little bit more painful rather than having a separate account that you don't even look at. It just sits there, grows, and you never consider it your own money. It's really just for them. And it brings even joy when you see that grow and you know it's for them rather than when it's all bundled into one. So I really like to keep those investments separate and have it in a dedicated account. Now, unfortunately, at this stage, not too many brokers do allow you to have separate accounts, but I will make a separate video about this in the future, which brokers I can recommend for that. But definitely one of them would be Interactive Brokers that will allow you to have a SEP account where you can basically, in your child's name or under your name at the beginning, start a separate position, separate portfolio, and then later on transfer it to them. But as I said, I'll come to this in a separate video just about which brokers I can recommend for that. And of course, we come to the very important topic of what to invest in, right? There's so many things you could possibly invest in. And again, there's no right or wrong. I can't be telling you what to do with your money because first of all, I'm not a licensed financial advisor. And second of all, it's your money, it's your choices. So definitely educate yourself. That's what I'm trying to do with my channel. But if I had to share two general recommendations, I think you really can't go wrong with either the S&P 500 ETF, which I'm also investing in myself for my personal portfolio, or of course, even more diversified, an all-world ETF, many different options out there. I have a whole playlist around S&P 500 ETFs, many different options out there, how they're composed of, why I believe in it long term. So I think either of them, you really can't go wrong. They're really quite diversified. Generally, if you really value diversification, then definitely an all-world ETF might be for you. And the idea here is really to set it and forget it long term. You don't want to end up picking individual shares, right? Because then it gets really tricky. You might be investing for your children 18, 20, 21 years, maybe even longer if you want to give them the money a little bit later on. So you don't want to be in a position where every month you have to log in and almost trade for them, right? That's not the whole point. You can do that for your own account, but for your kids' account, you want to have it on autopilot and just passively grow over time. And therefore, an ETF, I think, is really the best way to go about it. For your own portfolio, play around, have some individual shares, some more risky positions, no problem. But for your kids, you really don't want to put them into any kind of risk with their portfolios. So instead, maybe have slightly lower returns, but you know what you're getting long term. And generally, in this case, I would also recommend an accumulating ETF as opposed to a distributing ETF. In my own portfolio, I have a distributing ETF, means it pays me the dividends from those ETFs, which I then either can use for myself or automatically reinvest. Mostly I reinvest. But for your kids, again, you want to autopilot it as much as possible. So it's really set and forget it. So if it's accumulating, you don't have to think, I need to go in and reinvest the dividends. It's just automatically done on your behalf. So in this case, definitely accumulating would be the way to go. And you might be asking to yourself, maybe I should also add some Bitcoin to the portfolio, some other cryptocurrency, which is the future. And again, ultimately it's your decision. Personally, I wouldn't be doing that because while I'm a big believer in Bitcoin, and this is actually my second biggest position in my entire investment portfolio after real estate, more than my stocks and ETFs, just also because it grew nicely over time, considering the volatility and what will happen to it in 18 years, I'm just not too sure. Now, when I look at S&P 500 or old ETFs, these are companies producing revenues and profits, and whoever will be on top, it will change over 18 years. No question, in 18 years, we may not see Apple at the top anymore. It might be another company, but that's all done for you at the background. You don't have to think about it. While with Bitcoin, you're really kind of locking in one individual holding, which for me is just a little bit risky. I'm happy to do this in my own portfolio, but for my kids, again, as I said, I'm not here to, maximize the highest return for them. I want to have a nice solid cushion start for them, but I don't want to really risk anything for them, plus have a multi-million-dollar portfolio for them. That's also not the case, right? So in my case, I wouldn't be allocating Bitcoin. If you want a little allocation, you can, but again, just consider the risk and that you might have to monitor it a little bit more depending on global regulations. So many things can change over 18 years. So in my eyes, it's just not something I'll feel comfortable with for my kids' portfolio, but I will continue to have it in my own portfolio. And hey, if it does extremely well in the future, I can also use some of those gains, obviously to allocate later on to my kid if I wanted to. But let's have a look actually how those numbers can really compound over time, because it sounds very little, right? Putting 10 or 50 euros aside. But let me show you how that actually really grows over time. So here we are over on Match My Broker, where we have the free compound growth calculator. I'll link it down in the description below so you can run your own numbers later on. You can obviously change the currency over here. Initial investment, but I'm assuming you're starting off with a clean account for them with zero money in there. And then we talk about monthly contributions. And here it's really up to you. I mean, I would recommend at least 50 euros, but if you can't afford, you can also put 10 euros, right? It's still better than nothing. You'll be surprised. I'll show you in a second. Even at 10 euros, it still grows. It's still better than nothing. So it really depends on your own life circumstances. But let's start with 50 euros a month. Expected annual growth rate, 9%. Again, it could be 8, it could be 10. S&P historically returned anywhere from 8 to 10%. So let's go with 9% just for the sake of the exercise, but you may want to change those numbers as you see fit. And then we have the annual deposit increase over time. And again, that's also something just to keep in mind, because obviously if you start off with 50 euros today, in 10 years, hopefully you will be earning more, right? Most likely also 50 euros will be worth much less. So naturally, your employer will keep up with salary increases, or if you have your own business, you earn more. So let's assume a 5% growth of your deposits over time, meaning next year you would be contributing 52.5 euros per month, right? So I think that's reasonable growth over time. And then investment period, obviously we're assuming here for 18 years. Again, I'll show you different numbers also. The longer you invest, the better, and the shorter you invest, the worse. So definitely start early. And then we hit calculate growth, and you see here over time, the balance will go all the way to 37,000 euros. Would you be able to either pass on to them, as I said, or pay them out, or transfer the portfolio to them, whatever you want to do with it, right? I've also seen, kids that are really not particularly good with money. And so in this case, you may not want to transfer such a huge amount all at once, because it might completely, mess them up, right? And they spend it all at once or on stupid things. So in this case, maybe you want to pay it out in tranches, send them a monthly check or whatever, or again, say, listen, unless you go to university, that money is locked in stocks for you for later on, right? So there are different ways to go about it. You have to see what works for you. There's not one size fit all. And worst case, just leave it sitting there for longer. And if it's 25 years until that person kind of found a way in life, then he or she gets it later on. That's the beauty of investing. And the longer it sits there, the more it will grow. Even if you were to put only 10 euros, which I think is the bare minimum, hopefully you'll be able to shell that out. I mean, even Netflix subscription costs more, so I'm sure you will find 10 euros. But even then, it's still going to be 7,500 euros. Now, again, of course, in 18 years, 7,500 euros is going to be worth less than it is today. I get that. But still, it's a starting point. It's better than having nothing, zero money, and you'll be scratching your head. How can I find some money to help them towards their college tuition or whatever it is they want to do in their life? Maybe they have a business idea they want to start off, but they need starting capital. Why not help them, right? It stays in the family. I think it's an amazing gift to be able to pass on to your children. Now, on the flip side, if you increase this all the way to 100 euros, now all of a sudden you'll be looking at a portfolio size of almost 75,000 euros. Now, in case some countries, the kids go to college even later at 20, so you leave it until 20, that's almost 100,000 euros. So that definitely pays, a big portion of the college tuition or whatever they want to do with. That's a sizable portfolio that you could be passing on to them. So obviously it just shows you the more, the better, and the longer, the better. Because if I reduce the investment period now all the way to 8 years, because you started saying, the first 10 years, I'm not really interested in that. I just want to see how they develop. And then I start investing. You only have 8 years. Well, guess what? Now it only dropped to 16,000 euros. Still a nice portfolio, right? Nothing wrong with it. But it could have been, if it was 18 years, if I go back to 18 now, you start from the birth to 18, it could be 74,000. So a major, major difference over time. It just shows you do start early, right? Even small amounts, it doesn't matter, but time can be your best friend because it does compound over time. That's the real power and the reason why we want to invest early for our kids. How you can set it up is really very simple. Let's call it the 4-step system. First of all, we spoke about it. Open an account that is low cost and allows, have a dedicated account for the kids. Don't merge it with your own account. I don't think it would be very favorable, nor can you really track the statistics, and it would just make it very messy later on when you want to transfer their part to them. So have a broker that really allows you that feature. And again, I'll make a separate video about this very soon. Then you want to automate your transfers. So ideally from the bank where you receive your salary or your profits, whatever it is, set up a transfer from that bank to the broker, so you always make sure you have enough money in there, because then we come to the important part, and that is auto investing. Set up recurring buys. So basically every single month, week, however you set it up, those automated buys into either an all-world ETF, an S&P 500 ETF, whatever ETF or investment vehicle you choose, it's done automatically without you having to log in and doing it manually. Because trust me, if you have to do it manually, you will forget it. And the more often you forget it, that works against you or your kids' portfolio, because then there will be less time for it to compound over time. So definitely make sure it's done automatically. Set up recurring buys, set and forget it. So basically, that's step number 4. It's totally automated. The money from your bank goes to the broker automatically invests it. And then, as I said, have an accumulating ETF. So the dividends that you would be receiving are automatically also reinvested, so you don't have to do that. So literally, once that is set up, you don't have to even log into your broker anymore. You don't have to have an app on the phone to track your kids' portfolio. It's literally done. You can just set and forget it. And then 18 years later, you log in and you'll be admiring how your portfolio has done over time. And you'll be very happy to yourself. And of course, most importantly for your kid, that you provide them with such a nice starting base. So once again, make sure you adopt a long-term mindset, right? Be consistent, set up automated investments so you don't have to think about it anymore. It's just done automatically all the time. And of course, make sure to increase your contributions. That's what I've shown you in the calculations before. If you consistently increase your contributions with every year that you also start earning more, it will just continue to exponentially grow your child's portfolio over time, rather than keeping it flat at 50 or 100 euros for 18 years. You wouldn't do the same for your own portfolio, right? The more you earn, your lifestyle increases, but also your portfolio contributions. So do the same also for your children's portfolio. And of course, don't panic about market crashes. Here, you're really becoming a long-term investor. I mean, it doesn't matter if Trump comes up with some new regulations or some other tariffs, whatever it is, you're investing for 18 years. It's going to be multiple different presidents around the world. Things will happen nevertheless, but we've seen the same with the S&P 500. It's been around for decades and still on the long term has only grown over time. Yes, there have been ups and downs, but don't panic. It's not about market timing or optimizing the portfolio. Just believe in it. You invest in solid companies. As I said, pick ETFs that you really believe in long term, not individual companies, because then, yes, you may have to trade more, but here I really want to invest for long term. So don't panic, don't move in and out of positions, just dollar cost average over time. And of course, avoid volatile assets. That's why I said I don't invest in Bitcoin or anything very risky, because I want this portfolio to have a steady but predictable growth over time. Ultimately, remember, this portfolio is not for you. This is for them. And I think it's such an amazing thing to be able to pass such a gift onto them, to give them a head start in life. This is what I'm planning to do for my son, but I'm interested to hear from you. Are you already investing? Are you planning to invest? Do you have any questions? Pop them in the comments down below. Happy to hear from you. Next up, check out this video right here. As always, thanks a lot for watching. Stay healthy, get wealthy, and I'll see you in the next one. Ciao.